Absolutely nothing was learned from the 2008 financial crisis. So this is a chart courtesy of the Bank of International Settlements of total global debt in US dollars of public and private non-financial sectors of all reporting countries. The pin there towards the beginning of it's a little bit towards the middle, is the 2008 financial crisis. And we've just taken off globally with even more debt, even more credit. I'm a big financial historian. I'm a big studier of history. I'm an economic and financial historian. My first undergraduate degree was in history, and the more I learn about history, the old George Santayana quote is, "Those who don't learn from history are doomed to repeat it." Mark Twain has said that history does not repeat, but it does rhyme. But I can tell you from studying human behavior a lot, from looking through financial history, that normally a lot of painful lessons from the past are almost always routinely forgotten. Either intentionally they're ignored or they're routinely forgotten. It is a question of when and not if. Normally it's about a couple generations for the lessons to be forgotten, because a lot of the same painful mistakes from the 1920s and the 1930s are being repeated all over again. So unfortunately, the global economy has just gone insane with credit and debt. There's a global bull market in corruption all over the globe, and it is freaking crazy. Ben Bernanke was labeled as a, quote, hero, quote unquote hero, even with the courage to act. I think that was his bullshit book, even though him and Alan Greenspan and others were the architects of the collapse in 2008. So even though he was one of the people who helped set the fire, him, Alan Greenspan, and others, they were labeled a hero for intervening, creating quantitative easing, creating rules changes, allowing the banks to get away with accounting fraud. Basically, they don't have to mark to market still. They can mark to model. The FASB laws were suspended, and Ben Bernanke was labeled a hero, given a book deal, getting all these cushy six-figure jobs, and then it's right back off to the races. But I don't think any important lessons were learned from 2008, except that a lot of people now expect more bailouts, which is just ridiculous. I could name a bunch of different bailouts globally, including in 2017 when India got $32 billion in bank bailouts. I remember I was on an airplane flying down to North Carolina towards the end of 2017, and I was reading one of Real Vision TV's free newsletters, and Raul Pal and others were, I think, talking about this, because Raul Pal, I think, is half Indian, and he was talking about how all these bank bailouts for the Indian banks, like $32 billion, but I think the IMF or the World Bank said that they need $65 billion. Indian banks. I'm looking at a 2017, October 25th, 2017 CNN business article. Indian banks need a much larger infusion of $65 billion to comply with new international regulations that will come into force in 2019, according to Fish Ratings. The fresh government funds from a bailout should be enough to tide the state-run banks over for a couple years, but analysts say more uncertainty awaits. But I remember reading in this Real Vision TV free newsletter that they send to subscribers that's well written. It was really well written, but it was talking about how, the Indian banks have gotten multiple rounds of bailouts in the past over 10 years, 20 years, that just ridiculous that everyone expects a bailout now. If it's a bank and the banker screws up and the banker makes bad loans, the banker makes bad bets, the banker puts the bank and the shareholder capital at risk, the bank puts maybe the country's finances at risk, and the banker doesn't go to prison. Just ridiculous. I could go on and on. Real Vision TV, just for more examples of stupidity, Real Vision TV just did a new story out this week talking about South Korean corporations, how they borrowed way too much dollar-denominated debt. And South Korea, I think 50% of their GDP is based on exports. So their data recently has been really hurting because the global economy is slowing down a lot. I got a couple super chats. Thank you very much to Oscar Vasquez and Professor Curtis, Urban Treasure Hunter. Dollar devaluation. Do I think there's going to be a dollar devaluation? Yes, I think there will be an attempt in the near future, probably in at least the next couple months, probably 6 months or less, maybe even less than that, maybe in 2 or 3 months, maybe by the end of the year. that there will be an effort for a controlled dollar devaluation. If the dollar continues to rally, especially the trade-weighted dollar index, this will be a Plaza Accord. Go back and look up on Wikipedia the Plaza Accord. Basically, if the trade-weighted dollar index rallies too much, it's going to collapse a lot of emerging markets because they have borrowed way too much dollar-denominated debt, betting on a weaker dollar since really 2009, 10, and 11, the amount of dollar-denominated debt has more than doubled. I've covered this. So the emerging markets are in emerging market corporations, emerging market banks, emerging market governments are in big, big trouble because they have overborrowed the amount of dollar-denominated debt. If the dollar rally continues in the trade-weighted dollar, we could see massive amounts of bankruptcies in the emerging markets in 12 months or less. So I hope that answers your question, Professor Curtis. The thing is, here's the thing, if the U.S. does devalue the dollar, because the U.S. could use that as leverage if the U.S. is smart. My buddy Brent Johnson, Santiago Capital, has talked about this, that the U.S. could use it as an advantage in trade negotiations to say, we're not going to devalue or lower the dollar unless these other countries agree to other concessions or other beneficial trade deals for the U.S. So they could use it as a big, not just a wrecking ball, but also as a big leverage negotiating tool. So you could see the U.S. Treasury announce new trade deals with a bunch of other governments, maybe emerging markets, that are favorable trade deals. And in exchange, you might not hear this announced publicly, but in exchange, you might find out that these countries are agreeing to favorable trade terms with the U.S., and in exchange, the U.S. is saying that they're going to weaken the dollar. That would be part of it. But the U.S. has a good negotiating position, I would say, in that regard, especially with the emerging markets. And, the whole thing here with that chart, guys, it is insane how much the debt and credit has increased. A lot of old asset bubbles, a lot of old credit bubbles have been reflated. A lot of old asset bubbles have been reflated. The housing prices here in the U.S. are back up to astronomical levels. I believe in certain cities and states, the housing price levels and real estate prices for commercial real estate are even higher than they were prior to 2007 and 2008. And 10 years ago, guys, China had no debt problem at all. So now China is a big, big debt problem. Big, big credit problem, big, big dollar-denominated debt problem. There's these theories going around by some financial professionals on Twitter. They're not using their real name. I respect these guys. They're very smart. The theory is that China has been intentionally, and Miles Kwok on that Real Vision TV interview that was released this week, and if you haven't watched it, go watch it. It's about an hour long. I don't know if I believe everything Miles Kwok was saying, but if half of what he said is true, then China is a gangster mafia country run by like 10 or 15 families, and they're just plundering everything, and they're intentionally hyperinflating the RMB and then laundering the RMB out of the country in Hong Kong or London or other areas to get into other currencies like the dollar and euro, and they're even willing to pay a 40% money laundering fee, and then they're going and buying those stolen currency, which they didn't work hard for or earn at all. They just had the People's Bank of China print off billions for themselves extra, and then they laundered it out of the country to go buy real estate all over the globe, in Canada, in Australia, in the United States, in London, and go buy other hard assets like gold and silver and art, other things that affluent people want to own. So anyways, that theory is that China is intentionally hyperinflating their currency and that they're waiting to internationalize the RMB. As soon as the US restarts QE, then they're going to announce an RMB internationalization plan. But the problem with that theory now, there's a couple problems with it, and I think it more accurately measures what has happened years ago for China and not the future of China, is that, number one, from what I hear from sources in mainland China who have given me really good information that I've told you guys about, and it checks out, is that a lot of people in mainland China, including people in the mid-level and higher-ups in the CPC Communist Party of China, do not want to hold the RMB currency and look at the devaluation rate. And the other problem is China does not have nearly the negotiating power that they used to have because they have too much dollar-denominated debt. And the new capital controls and the rules that I talked about in the video yesterday, this confirms it, because the Chinese regulators, if those capital control rules are confirmed, the Chinese regulators have said clearly no more new dollar-denominated debt at all. No more new dollar-denominated debt at all. Which to me, in my opinion, my educated guess, is that China already has too much dollar-denominated debt and they can't handle it. So the U.S. is in my opinion, the U.S. is in a prime negotiating period. Now, I want to clarify something that I said yesterday on the podcast. If you listen to it, there was a lot of people who thought the stuff I said yesterday meant that I was bearish gold and silver. I am not bearish gold and silver. I am very bullish gold and silver. However, I was merely pointing out that private citizens in China who own 1 kilogram of physical gold bullion or more are risking getting confiscated. That would not be bearish for gold and silver, especially for people out of China. That would be bad for people in mainland China. But if you're familiar with how things are in mainland China, private property rights, there really is not private property rights in mainland China. All real estate is held with a 70-year lease, and it's very dicey. Carol says Chinese people innocent pawns to the government. Yeah, more or less, yes. I feel bad for a lot of the Chinese people. A lot of them are brainwashed. A lot of Americans are brainwashed. There's a global bull market in propaganda and a global bull market in corruption. I mean, you want to hear the height of hypocrisy? Obama, who was pushing climate change more than anyone else, he just bought beachfront property in Martha's Vineyard. So it doesn't make sense to me why Obama would do that. He just paid, $15 million for a beachfront property when he's been warning everyone about climate change and seawater and the sea levels rising. Hey, Jeff, there's a big problem, not only with fresh water, there's a big pollution problem, period, in China. Enormous pollution problem, air, water, and soil. What most people don't realize, and I talked about this yesterday, is a lot of dollar-denominated debt is tied to the Chinese real estate bubble. So a lot of these Chinese property developers that built these skyscrapers, these buildings, these condos, these apartment complexes, houses, all single-family homes, all these things, it was all built on speculation. They gambled because on a relative basis, the interest rates borrowing dollar-denominated debt were cheaper than borrowing in RMB, in the local currency, in yuan, and they bet that the dollar would get weak, and the dollar has not gone weak. So I think the U.S. has pretty good negotiating position here with the strong dollar. So these other countries, I can guarantee, I've heard sources that have told me this, and other people, other experts, like, I forgot exactly the experts, but I think people on Real Vision TV and others have confirmed that Federal Reserve officials and Treasury officials are getting phone calls from central bankers in emerging markets, from Treasury officials in emerging markets, government officials in emerging markets, and large corporations in emerging markets, and they're calling up the U.S. trying to get them to devalue the dollar. But the U.S. is in the position, guys, where they don't have to do that for free. They can demand something in exchange. They can demand some type of sweetener, some type of beneficial trade deal. They can demand these things. The dollar has gotten weaker against Charmin Ultra Soft. Yeah, shrinkflation. So there are a lot of the past mistakes from financial history are being repeated from the 1920s and 30s. There's a lot of similarities to the 1970s stagflation. Even recently, Ray Dalio came out and said, this story is from CNBC on Friday. Ray Dalio warns of serious problems and a bond blow-off as a repeat of the late 1930s looms. So I have been saying that what is happening now in the U.S. Treasury market with all this capital, flight capital coming in, leaving the U.S. stock market, leaving emerging market stock markets, leaving Europe, the European Union, and coming, probably leaving China, and coming to the U.S. Treasury market reminds me a lot of the 1927 to 1929 period where all this flight capital came into the U.S. stock market before the October 29th, 1929 Black Tuesday stock market crash. So Ray Dalio sees it a little bit differently. He says it reminds him of the 1930s. Okay, hedge fund titan, I'll read the article. Hedge fund titan Ray Dalio is worried that the current landscape is starting to resemble Depression-era conditions that can hammer investors. In a LinkedIn post Thursday, the billionaire Bridgewater Associates founder said high levels of debt and central banks' ineffectiveness are two of the key factors that need watching. The U.S.-China conflict is adding to the problems as an existing power battles and emerging one. Quote, if when there is an economic downturn, that will produce serious problems in ways that are analogous to the ways that the confluence of those three influences produced serious problems in the late 1930s, Dalio wrote. The post was consistent with a previous warning he delivered about a paradigm shift in which gold will serve as a profitable hedge as investors get caught holding too much risk. In the latest essay, he spoke of how central banks are being forced to keep interest rates low and, quote, print money to buy financial assets, end quote, in order to prop up markets and make huge fiscal deficits affordable. He said there are, quote, strong deflationary forces at work, end quote, as capacity has surged. In the real world, he must not worry about prices with his day-to-day living expenses. We know that there's not deflationary pressures in that regard. We know that there's stagflate and tax and lie. Quote, these forces are creating the need for extremely loose monetary policies that are forcing central banks to drive interest rates to such low levels and will lead to enormous deficits that are monetized, which is creating the blow-off in bonds that is reciprocal of the 1980 to 1982 blow-off in gold, he said. So here's the thing. He said that deficits are monetized, and he talked previously about deflation. When you monetize deficits historically, guys, it is very inflationary. It is best case scenario stagflation, like I'm saying. So if deficits are monetized, if the central banks create currency units, digital fiat currency units out of thin air to start buying up bonds or buying up with the Japanese central bank, Bank of Japan, they buy up Japanese stock ETFs, or the Federal Reserve all of a sudden has to buy up that toxic loan garbage, the collateralized loan obligations that I told you guys about in the last couple weeks, did a lot of research on that, the CLOs. And by the way, guys, those CLOs are all chopped up junk bond debt, covenant-like garbage. So there's a very realistic possibility that all that, at least $600 billion of CLO, could all go to zero. And then that would mean then you would have to have the Federal Reserve come in and buy it all back. Buy it all up, just like they did with the toxic mortgage-backed securities in 2008, and how the Federal Reserve's official stated balance sheet went from $800 billion, I believe, give or take, up to, in a very short amount of time, it went over $4 trillion. I believe the official Federal Reserve balance sheet got as high as $4.5 trillion after the end of, QE3. So I think the case is there that people just do not, for one reason or another, whether it's intentional or unintentional, do not learn from history. Because a lot of the same mistakes from prior to 2008 and a lot of the same mistakes from the 1920s and 1930s with beggar thy neighbor policies, with currency wars, trade wars, all these things are reappearing again. Where these central banks like the European Central Bank and the Federal Reserve are basically fighting each other now on who's going to cut rates faster. Last few bond auctions went badly. Silver Report Uncut says Fed is sneaking in QE, buying them up. The banks, the large U.S. banks, have the HTM accounts, the hold to maturity accounts. They don't have to do that. As primary dealers, they know that they can buy up those and either hold them in a hold to maturity account without marking the losses if they have losses on treasuries. Technically, there wouldn't be any losses on treasuries because the value of the treasuries is going up. because the bonds are inverse. There's a relationship with bonds where yields go down and bond prices go up, and when yields go up, bond prices go down. So the bond prices are going up. So anyone who's bought who has copied Stanley Druckenmiller and has bought U.S. Treasuries in the last 4 or 5 months has been making capital gains on bonds. Phil thinks there will be a 50 basis point cut. A lot of my friends, I was just speaking to another one of my friends about 2 hours ago, and he thinks the Federal Reserve is intentionally going to screw over President Trump and will do either 25 basis point cut soon or none, just to screw over Trump, based on what Bill Dudley said earlier this week, the former New York Federal Reserve Bank president, saying that the Federal Reserve should not help President Trump anymore and try to get Trump kicked out in the 2020 election. Max, I don't know if I fully agree with you, because if food prices keep rising, the amount of currency creation, I've covered this at length in China, the amount of credit and currency creation is so strong, and China has the African swine flu and other problems, and with China's own economic data, food prices have risen so much that if food prices keep rising like this, the average Chinese person is going to start protesting. And that is what the Chinese government really fears. Higher food prices and food shortages and people's standard of living being cut is what the Chinese government, one of the things the Chinese government probably fears the most, because that is what led to the 1989 Tiananmen Square protests. A lot of it had to do with lack of food, higher food prices and food shortages. But to add to another example of politicians not learning from history, President Richard Nixon here in the United States knew financial history. He knew about Diocletian. He knew about the wage and price controls in the Roman Empire that really hurt the economy in the Roman Empire. And President Richard Nixon put in wage and price controls when he was president anyways. So he knew, he ignored it. He knew it was bad. I believe he had done interviews publicly a year or two before he put in the wage and price controls. So it just goes to show you that some people might actually know the history, and they just ignore it anyway. If you want to read more about problems with the FDR folly, how Franklin Delano Roosevelt and his New Deal prolonged the Great Depression, and this leads it back into what Ray Dalio said. I'll continue with the rest of the Ray Dalio article now. Dalio's firm, which manages $124.7 billion for clients and is the largest hedge fund operation in the world, has performed poorly this year. Bridgewater's Pure Alpha Fund was recently off 6% year to date, and Pure Alpha is down 9%, according to Bloomberg. Dalio directed readers to study the economic and investing conditions of 1934 to 1945 as, quote, there is a lot to be learned by understanding the mechanics of what happened then and in other analogous times before then in order to understand the mechanics of what is happening now. It is also worth understanding how paradigm shifts work and how to diversify well to protect oneself against them. So, back to the FDR's folly of the policy interventions that former U.S. President Franklin Delano Roosevelt, the only one to have, 3 terms, because U.S. presidents are only supposed to have 2, or did he have 4? Did he have 4? Well, he had at least 3. I think he died during his 4th term because we were in the World War II. So he's the only U.S. president to have more than 2 terms. And this article is from the Foundation for Economic Education. FDR's folly, how Roosevelt and his New Deal prolonged the Great Depression. So this is going to go into Austrian School of Economics free market analysis on Ray Dalio talking about that time period there from the mid-1930s. Why did New Deal spending fail to lift the American economy? By Burton Folsom and Jim Powell. The Great Depression of the 1930s was by far the greatest economic calamity in U.S. history. In 1931, the year before Franklin Roosevelt was elected president, unemployment in the U.S. had soared to an unprecedented 16.3%. In human terms, that meant that over 8 million Americans who wanted jobs could not find them. 1939, after almost 2 full terms of Roosevelt and his New Deal, unemployment had not dropped, but had risen to 17.2%. And I would say that those economic statistics were a lot more accurate than they are now. So back then, the economic statistics were way more accurate. Almost 9.5 million Americans were unemployed. Okay, here's the key kicker here. On May 6, 1939, Henry Morgenthau, Roosevelt's Treasury Secretary, confirmed the total failure of the New Deal to stop the Great Depression. Quote, "We are spending more than we have ever spent before, and it does not work. I say after 8 years of this administration, we have just as much unemployment as when we started, and an enormous debt to boot." Okay, and if I could add in there that and I'm a history major undergraduate, all the generalist history books on the Great Depression and FDR, they totally leave out all of that stuff. It's almost all the generalist history books. There's almost no criticism of FDR for what he did to Japanese Americans with the internment camps, for the problems, misallocation of capital, how he tried to cheat and he tried to stack the Supreme Court. He was literally he ordered any business owner who tried to cut prices during the Great Depression there, any small business owner in the U.S. who tried to cut prices was risking going to prison, a very large fine, and going to prison. And there was even a Supreme Court case. And FDR and his cronies lost the Supreme Court case, and that's why he tried to stack the Supreme Court. He tried to rig it. So the generalist history books leave all this stuff out. If you want the straight truth on this, you have to go to if you want to read articles, you have to go to fee.org, Foundation of Economic Education, fee.org, or Mises Institute, or you have to read the books about the Great Depression by Murray Rothbard and also Amity Shlaes, Forgotten Man. There's other books that claim that they're good about the Great Depression. I've read some of them, and those are the best too. So continuing with this article in FDR's Folly. So this is a book this is another book about FDR screw-ups. There's a book called FDR's Folly. Jim Powell ably and clearly explains why New Deal spending failed to lift the American economy out of its morass. In a nutshell, Powell argues that the spending was doomed from the start to fail. Tax rates were hiked, which scooped capital out of investment and dumped it into dozens of hastily conceived government programs. Those programs quickly became politicized and produced unintended consequences, which plunged the American economy deeper into depression. So a lot of the same things. Taxes, the Trump tax cuts have not benefited everyone, and tax levels here in the United States at the state and local level are being raised on many different items, especially property taxes, but also other items. More specifically, Powell observes the National Recovery Administration, which was Roosevelt's centerpiece, fixed prices, stifled competition, and sometimes made American exports uncompetitive. Also, his banking reforms made many banks more vulnerable to failure by forbidding them to expand and diversify their lending portfolios. Social Security taxes and minimum wage laws often triggered unemployment. This is starting to sound familiar. In fact, they pushed many cash-strapped businesses into bankruptcy or near bankruptcy. The Agricultural Adjustment Act, which paid farmers not to produce, raised food prices and kicked thousands of tenant farmers off the land and into unemployment lines in the city. In some of those cities, the unemployed received almost no federal aid, but in other cities, those with influential Democratic bosses, tax dollars flowed in like water. So this sounds just like more and more corruption. There was a global bull market in corruption from what it sounds in 1920s and 30s. And then there was a big bust, and there's been a global bull market in corruption for a while now as well. Powell notes that the process of capturing tax dollars from some groups and doling them out to others quickly politicized federal aid. He quotes one analyst who discovered that, quote, WPA employment reached peaks in the fall of election years in states like Florida and Kentucky, where the New Deal's big fight was in the primary elections. The rise of WPA employment was hurried along in order to synchronize with the primaries. The Democratic Party's ability to win elections became strongly connected with Roosevelt's talent for turning on the spigot of federal dollars at the right time, before elections, in other words, and in the right places, key states and congressional districts. So he just threw other people's money at the problem. And Alexis, I've talked about this at length. I talked about this earlier this year in my Eat the Rich video. Alexis de Tocqueville, over 150 years ago, was saying the American form of government will eventually collapse. It is a question of when and not if the politicians learn that they could bribe the people with their own money. And this, over the years, this has just gotten increasingly worse. Powell's book is well researched and well organized. His chapter titles are a delight. I've not read Powell's book, FDR's Folly. Sounds pretty good, though. He synthesizes a mass of secondary sources and some primary sources in making a strong and persuasive case that the New Deal was a failure and that Roosevelt presidency, at least in his first 2 terms, was a disaster. And basically, FDR's programs were nothing new. He actually copied the generalist history books, actually label Herbert Hoover as a evil free market guy, evil capitalist. But the truth is the exact opposite. Herbert Hoover was a big interventionist. And FDR, basically, he lied, a bunch of lies. He promised lower taxes and less government to get elected. And then as soon as he got elected, he did the exact opposite. And he just copied Herbert Hoover's policies. He basically doubled and tripled a lot of Herbert Hoover's policies. And that was FDR's policies. So FDR is one of the worst presidents, in my opinion, in U.S. history. It's probably a tie of which U.S. president is worse between Woodrow Wilson, who created the permanent income tax, allowed the Federal Reserve, got many millions of American men killed in World War I, and FDR. I think they're both bad. There's a good debate over which one is worse, FDR or Woodrow Wilson. Powell covers all the New Deal programs in the book. He draws on the research of historians, both liberal and conservative, so this is a balanced book. And he is nuanced. There is no hatchet job in that he concedes that some of Roosevelt's policies, such as tariff revision, were more economically sound than, say, his industrial and agricultural policies. If you want to read the rest of the article, there will be a link to it in the information and description section. Koi City says FDR was more Hitler than Trump, yet Dems love FDR. I can't argue with you on that, buddy. Didn't over 1 million Americans die in World War I? No, I'm not talking about Jay Powell's book. I didn't even know Jay Powell had a book out. Over 1 million Americans died in World War I. Still a massive number. So now we're at the stage probably in the next 2 years where we're just going to be arguing over what collapses first, unfortunately. 10 years, that probably should not have happened. The global central banks and the mainstream financial media and the governments bought us another 10 years, and they made the wealth gap worse between rich and poor in many different countries, pretty much every single one of them. And now we're looking at basically over the next couple of years it's a question of when and not if, what will collapse first. And then what will be the after effects, the knock-on effects after that. Okay, a super chat question from Tarkinas. What will happen to gold and silver if 25 basis point rate cut? It might not do very much. Gold and silver are in bull markets, man. So the way it appears to me on the price action is when there's a correction in gold and silver, the dips are being bought now. Look, I think, Tarkinas, I've talked about this before. When you have a very well-respected global macro investor like Mark Mobius, and Mark Mobius is not a gold bug. You have another well-respected, I did a short video on this week, another well-respected global macro researcher, Jim Bianco, of Bianco Research. He's not a gold bug either, and they're talking up gold. I think there's a lot of people that follow the work of Mark Mobius and Jim Bianco, and if they're recommending all dips are bought on gold, there may be corrections along the way for gold. There may be $20, $50 drops in the gold price, but they're recommending to their clients to buy gold on dips. Thanks for the super chat, Austin. I appreciate it. And thank you very much to my almost 150 now Patreon account contributors. It is growing so quick. It's up. The amount is up, I think, fourfold in the last 3.5, 4 months, something like that. It's growing very, very rapidly now, which is really, really good. Making my life a lot less stressful, and I could just focus on good content. Free Awake Mind says U.S. will collapse first, then China. Chinese economy is already bigger than the U.S. I disagree. The Chinese economy is not bigger than the U.S. China's real GDP is very small. China's economy is contracting. There was a Chinese economist in mainland China who ran the numbers and said that China's real GDP in 2018 was 1.67%, and it was collapsing violently. And the economic data from China's own economic data from China's National Bureau of Statistics shows higher food prices, which are not good for consumer spending in the service economy in China, and their industrial output has from June to July was very bad. I don't know if China's going to be the first country to collapse first. My educated guess right now, guys, is the European Union is looking the worst and emerging markets. Steve says China will be dumping 1.3 trillion in U.S. bonds soon. And Steve, China has already been dumping treasuries, and it won't collapse the treasury market. I think you're reading way too much gold community bullshit. China already has less U.S. treasuries now than Japan. China's already down to 1.1 trillion because China has a dollar shortage, and they had to sell some of their U.S. treasuries just to stave off problems. They needed those dollars. Look, if I was, this is not financial advice, just my opinion. If I was a hedge fund manager and setting up trades and I was placing bets, I would be betting now on the European Union and emerging markets to collapse first. Which means China is slowing down a lot. I don't know when China would collapse. They're having a lot of problems there, but I think the problem with China's economy slowing down, base metals and oil and energy, those commodity prices are going to have in big bear markets for a while. RR says the European Central Bank can keep the European Union going. Actually, they can't. The European Central Bank doesn't have enough juice to save Deutsche Bank. It has to be the Federal Reserve. The European Central Bank I'll repeat this again, the European Central Bank does not have enough juice to save Deutsche Bank. It has to be currency swap lines of the Fed helping out the European Central Bank. The European Central Bank and the distortions that the European Central Bank is causing is actually accelerating the problems in the real economy in the European Union. So the European Central Bank can kind of keep things going, but it's just making things even worse. From what I'm hearing from sources, China's dollar shortage problem is real. It is very, very real. I just spoke to another source in the last hour and a half. Okay, I'm looking through listener questions and comments. This is not going to be a longer stream, so I'm probably going to shut it down in a little bit. This is a good question from Koi Cities. Koi Seas. Will China lay debt traps if the European Union fails? China has already been laying debt traps. China has laid a lot of debt traps. It's mostly been to emerging market countries like Venezuela and countries in Africa and countries in Southeast Asia and other Latin American countries. However, China has heavily invested in New Zealand and Australia and Canada. But the other new debt trap that China just did was in Italy. Italy is an enormous problem. Italian banks and the Italian government debt are an enormous problem. So Italy's in bed with China now, I believe. And I hear that France is also becoming very cozy to China too. Germany can bail out Deutsche Bank because Germany has no debt. It's not that simple. Deutsche Bank has $49 trillion in derivatives. The German economy, their GDP is only $3 trillion. In my humble opinion, I do not think Germany can bail out Deutsche Bank. because of this, what I've been hearing from sources since 2014 about the currency swaps. If that were true, if Germany could have bailed out Deutsche Bank, it would have happened already, and the currency swaps from the Federal Reserve have been preventing Deutsche Bank from collapsing for years, since 2008. I've spoken about this with Deutsche Bank. My educated guess is that the Federal Reserve, the European Central Bank, and the Federal Reserve may come out with announcements that they are guaranteeing some of the derivatives on Deutsche Bank. So the shares of Deutsche Bank may go to zero, but then there may be announcements from the larger central banks that the derivatives are being guaranteed. And that would kind of be like, okay, they let the shares collapse, they're recapitalizing part of the bank. That would be my educated guess now. How much does the IMF have to bail out? The IMF does not have a lot. Unless you believe that they're going to issue the SDR. Unless you believe everything Jim Rickard says. In my opinion, guys, China cannot sell all of those treasuries and collapse the dollar. Okay, I hear it all the time. People still believe. I still see articles that don't even have the right amount of treasuries China owns, saying that China's going to dump all their treasuries and collapse the dollar. I still see it. I see it on oil websites. I see it in the gold community. Okay, guys, well, I'm getting tired. It's a Saturday night. I probably have to make some dinner plans, and I might go out for some beers, go hang out. I'll speak to you guys later.